Hi everyone, Drini here, and welcome to my channel. So over the past few videos, we have been already establishing that the crypto space and the rest of the asset classes are most likely going on a bear market for the time being.
But Drini, what are you talking about? We just had a major relief rally yesterday for Bitcoin and the rest of the cryptos. We're not in a bear market.
Unfortunately, it's very important to establish that relief rallies exist. We don't go straight down before recovery. It's very choppy going up, it's also choppy going down. As long as we keep breaking down and establish lower lows and lower highs, then unfortunately, we are just in the beginning of the bear market. Now, while it's very easy to establish the beginning of the bear market, a key question that you may ask is, how will we know when it's the end of it? Or how do we know we're at the tail end of the bear market and are ready to begin the bull market once again? So today we're going to put our macroeconomic and geopolitical hat on in order to identify 5 key things for us to watch out for in order to address when the bear market could end. And let's dive in. The first one is the war on Ukraine and Russia has to end. And apart from the obvious geopolitical tensions that arise from having conflict in Europe, causing instability, fear, and uncertainty in the markets, there's one major reason why Russia and the Ukraine have to be at peace. These two countries are one of the world's biggest exporters of wheat. You need peace to occur in order for the global supply chains for food to return back to normal levels. Russia and the Ukraine, of course, are sources of oil, natural gas, as well as rare earth materials that are used for everything like, of course, energy and fertilizers, etc. The second thing that has to end is China's very strict COVID lockdown policy. Right now, Shanghai just had a massive lockdown occur, and rumor has it that as Omicron continues to spread across China, and as China continues to have severe, sometimes irrational reactions to the Omicron wave, the problem with these lockdowns is, of course, apart from the economic slowdowns from China, China is still the manufacturing country in the world. Supply chains ranging from clothes all the way to electronics are basically hampered by China's very strict policies in order to continue to implement a zero COVID China, which actually doesn't make sense because the rest of the world has moved on from the virus, only China remains. The third thing to watch out for is, of course, the US inflation rate. The US has been suffering from major inflation rates ever since the start of the pandemic, which is also not surprising. You lock down the country for the longest time, thereby limiting the creation of goods and services. They have also printed 40 to 60% of all of the US dollars ever printed over the past couple of years. Why people thought that inflation was not going to be a problem, I have no idea why. Anyway, inflation rates have to go down because at the end of the day, when you have massive inflation, it actually forces less consumption in the market because you're killing the demand side of the economy, and with a weakened demand side, it really cascades towards a weakened supply side, causing deflationary growth when it comes to the economy, thereby spooking the markets into being risk-off for the time being. So this 8.3% is the highest inflation rate so far since the 1980s. And one thing to note about inflation is it really takes a while for inflation to settle down. Comparing that with the highest inflation rates ever during the 1980s, after it reached a peak of around 14%-ish, it took around 4 years in order for inflation to get back to normal. So does that mean that we will only start getting a bull run after 4 years? Not necessarily. However, you cannot discount the fact that high inflation leads to very slow risk-on appetite across the market. When we compare this particular time period from 1980 all the way to 1983, during periods where the government really is hiking interest rates in order to curb inflation, when you map out the period between 1980 right here all the way to 1983, we had a massive drawdown for S&P of around 27% from here on November 1980 all the way down to 1982 before we rallied back up. So 1982 July was around this level right here. When inflation hit this particular support level right here, or this particular range right here, this was when the market started to rally, when we have finally confirmed that inflation is back under control. So from an inflation standpoint, what we're hoping for is this is the peak, because the longer we go up, the longer it will take for us to recover back down. So if this is the particular peak, then hopefully, given the Fed tightening that has been happening where they're increasing interest rates, you would start to see particular drawdown right here. And hopefully when it reaches key support levels, for example, if we are able to go back down to, let's say, around 3% or even here at around 3.9%, then perhaps the risk appetite will come back here and be rally before inflation goes back down to much more reasonable levels. So just take note that in the 1980 example, inflation doesn't have to go all the way back down to the previous lows. What can potentially happen is once it reaches comfortable support levels or comfortable levels for the markets to gain confidence once again, expect that markets will start to rally again. The fourth indicator that we have to account for is we have to look at the NASDAQ to see where could it bounce. NASDAQ and Bitcoin and the rest of the crypto markets are highly correlated at the moment because how large financial institutions think of Bitcoin, they think of it as a highly volatile technology stock. Hence the correlation with NASDAQ, because NASDAQ, for those of you who are not aware, NASDAQ is pretty much the index of technology companies in the space. So the key thing to note for NASDAQ is we are going down right here and there are a couple of levels to look at. Are we going to hold the line here at the 200 MA of around 10,679? Personally though, maybe not. This level is what I'm watching for. This level right here of around 9,612, this was the high of the pre-COVID or pre-lockdown periods. So a potential scenario here is as the Fed keeps tightening, we may find ourselves in a situation where we will have a relief rally right here. For example, the EMAs will continue to go back down, get rejected once again, eventually fall to this particular period right here before we eventually bounce back up. Another interesting to note though is when we overlay the Fibonacci, where this is the break in structure, where this is the 1 right here because this is the confirmation candle that we have broken structure, and this is the 0. What's been happening is when we reached the 1618 extension for the NASDAQ, we had a relief rally up. So this is actually not surprising because the 1618 typically is where most traditional assets bounce off before continuation either to the upside. However, given the global macroeconomic trends that we have highlighted before, this may just be a temporary relief for the NASDAQ. And as Fed continues to tighten, then of course we will eventually go lower. The pre-COVID levels are largely in line with the 2.272 Fibonacci extension right here. So it remains to be seen where could we potentially hold for the NASDAQ. If we fight really hard right here and get rejected, maybe we just have a double bottom at the 1618 before continuation. Otherwise, if we continue to break down, then a potential target, of course, would be the 2 right here of around 10,583 or the 2.272 of the pre-COVID lockdown levels right here. And finally, of course, Bitcoin itself could be an indicator of a bottom for the crypto markets. So for Bitcoin, after looking at it for a while, I realized that our assumption in the last video that we will mostly mimic this particular pattern right here doesn't appear to be correct. This whole cycle really closely mimics the 2013 one. So when we overlay the cycle side by side, this is actually where we see a lot of similarities that are happening. The first one, of course, was back in 2013. 2013 was a double peak cycle. This was also a double peak cycle right here. It's just that this particular peak unfortunately got hampered by everything that's going on in the markets. And when you compare the 2013 bear market right here, the 2013 bear market, if you notice, was characterized by just a slow bleed to the downside. Similarly, the way we have bled since the 69,000 right here, what have we experienced so far? We just experienced slow bleed after slow bleed, sometimes giving us hope, but eventually we just kept going down right here. One of the potential scenarios moving forward is when we overlay the fractal from here. This particular candle right here, all the way to this particular recovery. If the macro environment appears to be weak and we will continue to slow down for a while, a potential scenario is we can have something like this, where this particular candle right here, it appears that this was this capitulation, but what's potentially happening here is we are just in this phase, not yet at the bottom of the structure. So what we are experiencing here is we will most likely experience a wave 1 right here, a wave 2. This is the wave 3. This is the wave 4 before the subsequent move to a wave 5. Followed by the ABC correction, which is basically an accumulation range where this is the A, this is the B, this is the C. most likely have a one more capitulation down before we rise up again to form new cycles moving forward. So these are the 5 things that we have to account for in order to identify whether or not the bear markets are over. Some of them are highly correlated. Some of them may not be as big of a factor as we thought it will. Time will tell. A word of advice at the moment is really to be cautious, be patient, and whatever money you're committing to the markets at the moment, just make sure that it's money that you really can afford to lose, or it's money that you can willingly wait for a long time for it to be fruitful once again. This is not the time to start borrowing loans in order to buy whatever assets that you want to covet. This is really the time to practice patience, and more importantly, the self-discipline to wait it out, identify key levels that you want to enter. If those levels are met, then you come in. If those levels are not met, then you patiently wait. Yo, before you go, like this video, subscribe, and share this video to your friends. Thank you very much and have a good day.